Well, I want to wish everybody a good morning. We did have a snowfall in 2021. We might have one more. I think the groundhog said that we got 6 more weeks of this nonsense. But the groundhog in New York State, I heard they recorded it a week ago and did not give an accurate reporting. So that's what I heard in the news today. So, but anyhow, thank you for those of you who are members of LIAFPN coming to another great event. Next event we have planned, we're going to have someone from the SBA, Erica Chase, speak in the morning, and then we're going to have an attorney speak on women and minority businesses. I think it's going to be a terrific event. We have these Zoom events every 2 weeks. Fellow board members that are on the call right now, Larry Bloom and Phil Kanyuk, been very helpful in organizing and creating a great atmosphere for everyone. I want to get this meeting started because Diane is a very energetic and terrific speaker. She started a division of exit planning with a group on Long Island and was very entertained and educated by her meetings. And with no further ado, Diane, take it away.
Thanks, Neil. I appreciate the plug for XPX Long Island. I think there are a lot of good synergies between these two groups. So if anyone wants to attend the Friday meeting, just send me an email. I'd be happy to get you registered. We're going to be focusing this Friday on sales growth and optimization in a flat management structure. So we're going over a case study of an exit for a technology firm. I've got a lot of information to go through. How much time? We try to be done by 9, Neil?
Yes.
Okay, so I am going to talk as fast as my non-caffeinated mouth will allow for. It is a lot of information. To the extent that anybody wants to take a deeper dive afterwards, I'm happy to have a meeting with you. To the extent you want me to do any homework, Tom knows this, I offer all the time. The information I'm about to go through, Bernstein does as a service, not only for our clients, but for what I like to call my external colleagues. So we do it for professionals in hopes of allowing you to interface with your clients better should they be transacting or even thinking about transacting and need to go through a few different scenarios. So I will share my screen. Can everyone see my screen? Take that as a yes.
Yep.
Great. And you can hear me okay. All
Apparently
right.
some people are having trouble getting connected. I don't know why. I know. Okay.
Okay. Well, again, I'm happy to share this deck afterwards too. If anybody wants to go through it, I'm happy to share, even with fellow wealth planners and asset managers. It's all about being collegial. So Richard Weaver, my national director who deals with executives around concentrated stock positions, going through exit, comp, etc., came up with this clever title. It's a wonderful deal. Selling your business to achieve your goals. Of course, disclaimer, have to put it up there. Peter, you'd mentioned attorneys earlier. So M&A, I think Tom is very familiar with this world because he lives in it. But interestingly enough, you may not know there's over $1.5 trillion of dry powder on the sidelines right now that private equity firms are itching to put to work in 2021. So when you have a transaction, also the majority of the businesses, I believe it's as high as 99% of businesses in the US are private businesses. So even though we all pay a lot of attention to the stock market, the bulk of our economy and our businesses are in the private sector. So when someone's thinking about transacting, these are all pretty obvious. I'm not going to reside on these too much, but a lot of times it's generational shift. Baby boomers who are retiring. That's a pretty common theme that we have in Long Island right now, especially as people are looking to exit some of the manufacturing or aerospace and defense industries. Some estimate that 30% of family businesses will be transferred to the next generation, and under 15 of that is going to go to the third generation. So you're not having a lot of transfer amongst families for the businesses. Sales to private equity firms, we just touched on. Sales to strategic buyers, that can be a little bit trickier, especially when you're in a fairly closed economy, because that can have a lot of competitive pressures. And a lot of times owners may not think that it would be best suited for their employees and could lead to job turnover that they really would like to prevent. And then sales to ESOPs. So the M&A team of professionals, we all reside in here and work around the business owner. And for me, it's really important for you all to understand that at Bernstein, we only do investment management and research. So to the extent that I can be helpful to quarterback any of other team members or message some information or some concepts that could be a little bit tricky to handle, that's often a seat that Bernstein does and is willing to do and take up the EQ card. So the case study I'm going to go over really shows how we use a holistic approach to transaction planning. What we want to do first is use our wealth forecasting analysis, and we can use that to really dimension different deal structures. This is helpful when somebody is, a year or more, ideally maybe even 16 months or more out away from a deal, and they can start thinking about what that money will mean and what different levers they can pull for planning and how that impacts their long-term family wealth. So I said that we can go around some roadblocks. These are some of the common ones. An owner is looking for a higher price than what the market offers. That's not too surprising. A lot of owners and founders are very emotionally attached to their business. You probably have heard other speakers address it and say it's like their baby. Owner could be anticipating a lot of business momentum and they're hesitant to miss any upside. They might not think it's a great time to sell. They may not seal the deal. A lot of times, like the case study I was mentioning earlier that we're going over and the exit planning exchange, it's a flat management structure and they got a couple of offers, but they didn't seal the deal because they didn't really think that their business was being appreciated by the strategic buyer. And then there's a tax liability. Some people just look at the liability and taxes and they don't want to have to fork over a big chunk of cash upon an exit. And that's another thing that we're going to address in this. So we try to prioritize. The first thing we want to do is get a business owner to start thinking about decisions that they have to make. And I like to put it in the terms of pre-experiencing decisions. So if you can get somebody to pre-experience the decisions, not only from a logical standpoint, but from an emotional standpoint, then they're going to be more comfortable when the time comes to actually pull the trigger and make that decision. They'll know what their hobbies are going to be post-exit. They'll know how their family is going to act in the community, what philanthropic legacies they may have, or maybe even they could have another venture that they want to start. They understand all of the options that they have, and they have a well laid out roadmap. So now I'm going to go over a case study. John and Julie Garcia, they're a 60-year-old couple and they want to sell their business. They want to retire. They do have a manufacturing company. Last year's EBITDA was $5 million and they have $1 million already in tax deferred accounts. One of their primary goals for the skiers on the call is they do want to purchase a vacation home out in Colorado for $3 million. A couple of years ago, that probably would have sounded expensive. I think right now that's a low price for out west from what I hear. And they want to also keep a $300,000 a year spend. So that's where they think that they would feel comfortable living for the rest of their lives. Their secondary goals: give money to their kids and their grandkids, give some money to charity, maybe invest in some new ventures, and of course, minimize their estate tax exposure. So we want to figure out if that sale is going to allow them to meet their goals. They've got two offers that they received. One's a all cash offer, and it's $30 million from a local competitor. And then the other one is a leverage recap from a PE firm. They want to give them $24 million cash up front and then roll 20% of the proceeds into a newly formed company. And that would also allow John to continue for 5 years as CEO and earning that $300,000 a year. I think we're all really familiar with the concept of compounding growth and not spending can help your long-term wealth. So the two things that we want to look at first for them is looking at the all cash deal and looking at the income tax and where they would be from the strategic buyer as well as from the PE buyer. So we can see that, of course, they're going to get more money. Oh, I started reverbing. Okay. They're going to get more money upfront from the all cash deal, but they have more upside if they do have a second bite of the apple from the PE buyer. I'm not sure if someone unmuted or has a question. I'll pause.
No, we're good.
Okay.
You have your
So
computer speaker and your iPad speaker on?
No,
No.
I'm just through my Pixel buds in my ear. Everything
Okay.
else is muted.
Okay.
I think someone might have their mic on who's participating. So what deal should they choose? Can they keep their $300,000 spend? Can they get their home in Colorado? How much can they give to charity and their kids? And how much can they transfer to their children and their grandchildren? These are all really important key questions for them. And as we dimension those out, will help them choose which deal they want to do. Our wealth forecasting tool, I'm not going to spend a lot of time on this because it's really a marketing pitch. And if anyone wants to know more about it, I can do that on the side after this call. But really, it's a probability analysis. You see that typical market pattern off on the right. This is a Monte Carlo simulation. It's going to run 10,000 observations. It's using capital market research. And it's going to look at the probability of a typical market pattern, which is 50%, and then great and hostile, which are going to be the 10% wings. So if we look at different allocations for them when they're going to look at the next 30 years, we're going to show them what an ultra conservative, which is an all cash and bond portfolio, then a conservative portfolio, which is going to still be mostly bonds, and then moderately conservative, which is very conservative, to be honest. They're looking at 35% stocks in the moderate conservative. And then the moderate, they're going to go up to 55% stocks. So what the important part is dimensioning out is looking at what their probability is to experience a 20% loss from peak to trough. Business owners tend to be very nervous when they think about investing their money. They tend to be very comfortable with real assets, investing in things like real estate or restaurants where they can actually understand the business model and cash flows, and the markets can seem theoretical to them. So what you really want to do is dimension that downside and really illustrate the conservative scenarios so they can get comfortable and see that they're not going to be putting everything at risk. Just to let you know, from a statistics standpoint, the green bars, or the teal, I guess you could call them, represent about 80% of the outcomes. In general, when I'm reviewing this with clients, and if I were to have a pen, I would just scratch out those top numbers. I really want people to focus on that 50% and then on that lower bound. So the good news is they learn that there's a 90% confidence level in all of the scenarios, that they can keep their desired spending of 300,000. So that's automatically going to make them feel a little bit more comfortable. They understand that the probability of a peak to trough loss at sub 2% for the ultra conservative conservative means that they can probably take a little bit more risk, but they don't want to go moderate and risk too much at a 30% market loss. So we're going to move forward with the moderately conservative allocation, knowing that in any scenario, they can keep that $300,000 spend. Now, the interesting part comes when we start to look at the all cash deal versus the leverage recap deal. So the leverage recap, they were rolling 20% into a new company, and there would be a second sale. So we're going to dimension the second sale just being at the flat 6 million, or potentially having it double. So that shows them that there's a lot more upside in the second sale potential. So how are we going to dimension out for them that they can get more upside? Doing the private equity deal probably gives them greater security for their employees because they don't have to worry about a strategic buyer who is also a competitor reducing staff. And it's going to allow them to continue to work for a few more years, which is going to help bolster that spend. The important things that they want to know is, can they have their house? Can they give money to charity? And can they transfer wealth? So how we dimension that is we dig a little bit deeper, and we want to figure out what their core capital requirements are. What do you need just to have your basic living expenses and to live comfortably for the rest of your life? The key drivers in that, you don't have to be a rocket science to figure it out. It's age, spending, and asset allocation. But we're going to stress test that for inflation, bad markets, and, to be honest, living longer than you would anticipate. This is not the couple that we're reviewing. This is just a hypothetical. If you were looking at a 65-year-old couple and they were spending $100,000 a year in a 60-40 portfolio, what would their core capital requirement be to spend at a 90% confidence level for the next 30 years? So we dimension that typical market and that hostile market for them. And they know that today they would need $3 million to sustain that spend, looking at just average and hostile markets. So we're going to take this and apply the core and the surplus capital to our couple, the Garcias. Again, it's that 90% confidence level. So sometimes that can be a really conservative number to review with a client. And often I like to have in my back pocket a 50% spend, a 50% confidence level, as well as a 75th percentile confidence level. Because some people know that they may reduce their spending as they get older. And they also want to know that they can keep their lifestyle when they're in their 50s and 60s and 70s, and they still want to travel and maybe buy a couple of toys. So how much can they give to family and charity? Coffee break. Using that core capital and surplus capital, we know that to support their $300,000 purchase of their home, or the $300,000 spend in the $3 million vacation home, that they need 11.8 million today in core capital, and that will support them for the rest of their lives. So the remainder of that, looking at the all cash up front, what they're getting a little bit over 19 million in the private equity deal, that 8.4 becomes surplus capital. And that's where you can start dimensioning the surplus capital to look at what's going to happen in the second sale and how you can use that surplus capital now to help them give to charity and also save in taxes. So you have a couple of different ways that they could give to charity. Of course, not everybody's philanthropic. This may not apply to everyone, but you can give directly to charity, to private foundations, or to a donor advised fund. I think we have a lot of people on the call who are familiar with the tax implications for this, so I won't spend too much time here. But the interesting aspect of using a donor advised fund over the others, while they all have immediate tax deduction, if you use a donor advised fund, you can donate low basis stock prior to the deal. And that can be very beneficial, as well as get an income tax deduction today, a charitable income tax deduction. So if they were to wait and give cash after the sale, they would have an income tax savings of $400,000. But if they go ahead and gift the units of their stock before the sale, they're going to have an income savings of $800,000 because they're going to avoid capital gains. There's a tax avoidance on the sale, and then they also get the immediate deductions for tax savings. And if you look at the beginning assets into that donor advised fund, a fun little thing that a lot of my clients like to do too, it may be a donor advised fund, but some people name it either after a loved one who may have passed away and use it as a foundation, because you can really name a donor advised fund anything you want. So often people put the word foundation in the donor advised fund, and that makes them feel a little bit more special when they're out in the community making charitable donations. So if you look out 30 years, you can see where the remaining assets are, and the total philanthropic value of the donor advised fund 30 years out is a little over 8.5 million. So that's pretty significant, and it also allows their legacy to have a significant charitable effort that they can use too. So giving money to their kids and their grandkids, we're all aware of the annual exclusions. If they want to use that and also gift to their grandchildren, that's going to be $180,000 total per year. We know if we have a core spend of $300,000, that 180 per year could be a little bit of a stretch for them up front. Or they could also look to sell a portion of the retained equity interest to an intentionally defective grant or trust. I am not a trust expert by any means. I'm very thankful that I have external colleagues who are, as well as an internal analyst who's a former partner at a trust and estate law firm. So I often throw the ball over to Tom Pulowski's way when we're starting to have these discussions so that we can really dimension it well for clients and prospects. So this is what it looks like when you're giving to an IDGIT. The donor can gift to the IDGIT, but any gift that they make, the donor is considered owning it for income tax purposes. So that's really going to allow the income and the capital gains are taxable to the donor and allow the IDGIT to grow tax-free. So it's a great way to get wealth out of an estate and to transfer that wealth to your beneficiaries. I'm sure you all know the IRS rules, so I won't spend a lot of time on that, but they do say that the income tax does not constitute a gift of the trust for gift tax purposes. Now, this one is a little bit visually unattractive, but the gist is if you sell your shares to an IDGIT to transfer wealth, what the Garcias are going to do is they're going to gift $300,000 worth of shares to the IDGIT. And then they're going to sell $2.7 million worth of shares to the IDGIT. The IDGIT is going to make an interest-only payment back to the Garcias. And if the Garcias are able to sell for that $6 million in that second sell, the IDGIT's going to repay the $2.7 million note. And that will take the income tax of the shares to the IDGIT away from the Garcias, and it'll leave $3.3 million in the trust, and they'll get a balloon payment back for $2.7 million. So giving to charity and to family, we reduce their estate. And if you look at scenario A, you can see with no planning, they're at 83.9. And their pre-tax estate, after we've given to a DAF, we've done some annual gifts, and we sold shares to an IDGIT, we've reduced that amount to 47.1. And that, of course, is going to lower their estate tax liability. So when an owner, this construct has helped a lot, especially when a owner is looking to sell a company and the buyer's offer may be a few $1,000,000 off from what they're expecting. The number that I always have in my head is a deal that the owner wanted 250 and they were being offered 244, and they were really getting stuck and they wanted to walk away from the deal. But when you can dimension out how you can help them save money today and then really grow the estate and their legacy and their philanthropy, that can help get a deal back on track. So they have their after tax estate at 38.5 after the planning, 8.6 is going to charity, and 30 years out, that IDGIT's going to look to be at 36.5 million. So their total estate has, or their total worth from the deal through giving and philanthropy is going to be 83.6 million from taking away from the tax bite versus a 60.7 of no planning. So putting it all together, this is the roadmap that they will be given. You know, immediately set aside some tax to pay for the liability based on this initial core and surplus analysis. They know that they have their core capital for their vacation home and their spending for the rest of their life. That is set aside. And then we're going to dimension the surplus capital in a way that they can give to their family and charity in a way that's meaningful for them. So in a nutshell, I know I went through that really, really fast, but what we're trying to do is remove uncertainty in a deal and translate that deal into a lifestyle benefit. So when you can take the money and really put an EQ around it, while the wealth forecasting analysis, and when we put one together for somebody, it takes about 2 weeks to run all 10,000 iterations. And trust me, I won't go over a 100-page presentation with anybody, but the cash flows in the appendix are quite meaty. So you really take this quantitative analysis and you can translate it into lifestyle benefits, which is really, really helpful to dig into what money means for somebody. And those EQ talks, those psychology talks, I think we all jokingly say that we play a psychiatrist as well, can help unlock additional value, not only for the owner, but for the family. And this is the phases that we help in at Bernstein. I'm sure a lot of you do as well. The pre-sale phase, the due diligence phase, and the post-sale phase. You know, using everything I just mentioned in the pre-sale phase is extremely helpful. Again, it can help a transaction take place more quickly when the right thing is put in front of them, and they really have a good sense of what they want to do with the money, and they can map out. You know, we can go as far out as 50 years for millennials that are doing sales. So it doesn't have to be just a retired company And I've seen some really interesting things happen with the surplus. So it's fun. And that's all I got.
Excellent. Does anyone have any questions?
I have a quick question.
Sure.
Yeah, I'm Noel Goldfarb, but I want to first thank Larry Bloom for inviting me here today. I appreciate that. Very, very good presentation, Diane. You had mentioned in that presentation about intentionally defective grantor trusts. From my experience with those, obviously the grantor is responsible for the tax on that, and that tax can continue to rise, and the trusts, from my understanding, have a lower threshold with regards to the tax brackets. So you don't need to earn as much in there to hit the highest bracket. Is that correct?
I see Larry.
Yeah, I was going to
Go
just
for
say
it.
Right, the tax is paid by the grantor, the individual.
Right.
It's not like a
the
real
brackets
trust.
of individuals.
Right, it flows through. Now, what we've seen when we've done this, at some point in time, the tax burden becomes too onerous for the individual who's gifted the shares.
Right.
We generally then decant the trust to like an electing small business trust, where the trust ends up paying the tax after a while. You know, once the owner, the initial grantor, is kind of limited his estate liability and also was running out of cash on his own. So
right. Well, one of the solutions, because I've had clients like that who've had these idiots implemented in the past, and they had that issue where the tax burden was getting too large. So we came up with a solution where if you insert a life insurance policy inside the trust, you can use the income from those investments to pay the premium, which will reduce the tax liability because there's no tax liability on an insurance policy. So again, just an idea, if that, this way you don't have to decant it, you can just insert a life insurance policy, which also increases the legacy as well, because it leverages the wealth in that trust.
That's a great option.
And to your point too, if a family or owners are interested in some diversifying asset classes like alternatives, that life insurance can be a great place to house alternative investments in an efficient way.
And
So
additionally, when
I
you
just
put up the insurance in there, you are also going to have no crummy powers. There's no crummy payments because the trust owns the policy for the trust.
outright, yeah.
Another thing, I'm quoting Tom Pulowski, my internal resource. And if anyone ever wants to dig into some of the things he's doing, he's a national managing director for us. So a lot of times I like to connect him with my professionals locally, because he sees what's going on across the country. And as we all know, industry can be specific based on region. So he has a couple of things that are creative translations. But one thing that he points out that I didn't, in regards to the note, you can always forgive a note. You know, a lot of people are worried about exclusions and gifting. You can't forgive a gift. So if anything changes with exclusions, it's easy to forgive the note and switch it to a gift, but you can't do the reverse.
I guess if I want to also point out that this is going to be an interesting year for us in the planning arena. We don't know what's coming down the pike in terms of income tax rates, although we kind of have an idea of what his plan is, and also estate and gift tax rates. Obviously, you know, and lifetime exemptions are going to probably go down. The question is, will the concepts of lack of marketability and minority interest still exist? And we don't know what that holds. So this may be a great year to really update your estate planning tools and take advantage of these intentionally defective grantor trusts and other types of estate planning vehicles.
And with that in mind, we're not sure where capital gains tax is going to go either, long-term and short-term, especially in business transactions. So the nice thing about this group is we have a diverse set of people here. Larry Shear being an estate attorney, me being in insurance, and Peter Lichtenberg being insurance professionals, and Phil Kanyak who can help evaluate businesses, and Diane who can help invest the money And that's the purpose of the group, is the LIAFPN, is to have these resources. When you have a situation, run it by us and let's see how we can all help one another and help at the end of the day, help the clients and be current
Absolutely.
and be up to date as to what the goal is.
And help our economy too, right? The more we collaborate
Absolutely.
together, the better we can help our local economy. I was going to give a little bit of a selfish plug too. For those of you who don't know, I have a podcast called Winged and Ready. One bad marketing decision on my point, it's an ampersand. It's not the word and, it's winged ampersand ready. But I did have Tom Pulowski as a guest last year, as well as Richard Weaver and Ann Bucciarelli. A lot of times I don't have internal Bernstein guests, but I wanted to dimension what it looks like when I take deep dives with each one of them in this type of a framework. I try to keep them to 20 to 25 minutes. So to the extent it's helpful for you guys to listen to Tom Pulowski, Get What You Need is the name of the episode. You can listen to some of the things that he has done with business owners. Yes, AFR, exactly. Take advantage of those low rates. What are the AFR rates right now? I haven't seen an update on them. The long term's a little over 1%, I think, right?
Yes.
They're all under 2.
Yeah, very low. And Peter, you
anybody
mentioned
wants
something about a charitable LLC. What were you? I didn't get a chance to read everything.
Well, with a charitable LLC, you can pretty much achieve a lot of everything that Diane was trying to achieve. And at the same time, for instance, Bernstein would be able to continue to manage the assets inside the charitable LLC, but you donate, whether shares of your business or marketable securities. You can donate cash. You can donate a lot of things to the charitable LLC. It has to be a bona fide 501c3. You basically ultimately give up 90% of that asset. You retain 1% as the managing member and the controlling member. And you've generated the tax deduction, and you can borrow out income. You can borrow out money from the LLC if you want at the AFR rate. You can borrow out money to fund a permanent life insurance or replace the asset for your legacy, for your family. You can do a lot of things with it. It's very flexible, but there's structure to it, and it works in conjunction with Diane. So I mean, Bernstein's goal is ultimately to retain and manage the assets, and this is another great vehicle for them to do it. And at the end of the day, the asset reverts to the charity long term, but the family replace that asset with life insurance.
How does that work better than the charitable remainder trust with the reclamation islet?
Well, we have to refer to Diane's trust experts for those answers. But I'm happy to share a piece on that charitable LLC. And I will say, Diane, you mentioned that they had, I think in your presentation, $1 million of qualified money. So it's by donating something like, so another strategy is you could take that qualified money, donate it to a charitable LLC. And when you do that, you generate a deduction, right? So now what you can do theoretically is you can borrow that money out, but you can use the deductions to convert qualified money to like a Roth. So you generate a large deduction, and now instead of writing a check for the tax for the Roth conversion, because you've donated an asset, you now have that deduction to convert the qualified asset to a Roth. I mean, I have a piece on it. I'm not the expert on it. I'm just a messenger. And
Why
you
don't
could
you
also
forward that to Neil?
annuitize it out as well, and spread the tax base out over a long period of time. And then if the goal is to leave it behind, use that for an insurance purchase as well, which we do in some of the trust work that we do. So.
Yeah. Peter, why don't you forward a copy of that article to Neil, and Neil can forward it around to everyone.
Great,
Yeah.
Will do.
All right. On an ongoing basis, Neil, what's the next presentation?
The next presentation, I was said earlier, I know people had trouble getting on this morning. We have someone from the SBA, Erica Chase, who's very helpful to a lot of small businesses and accountants in helping people secure the PPP loans. She's very adept at going over the process, what's happening with the government on a regular basis, on a real-time basis. And again, is a tremendous asset to have and listen to. And then Lisa, is it Lisa Durant?
It is.
Is an attorney, business attorney who works with women and minority businesses. And she's going to do a presentation regarding that. So it'll all tie in together. Very excited. I think it'll be a great.
And is that on the 17th?
Yes, every 2 weeks.
Excellent. Okay, excellent.
Anything else? Listen, we
This
thank
is where you
everybody.
do
for
the
coming.
pitch for new members.
Yeah, no, we'd like everybody to join, joining this organization helps us make introductions to people. That's one of the biggest things. We are a network of professionals then, and at the end of the day, we're going to continue to educate. The money that we're asking for is minimal. It's like $250 for the year. That money goes towards marketing, basically, putting together these Zooms, sending the advertisements out, following it up with recordings, and then introductions, which it's really not it's a nonprofit, and we all hope to grow together and get bigger until we go live again, which we're not sure when that will be. I'm not making any guesses on that.
Okay.
We should do an event together when we all go live again do a joint event with XPX. That would be fun.
That would be fantastic. Love to do it.
And I have a little white paper that reviews the presentation I went over. If anybody wants it, or Neil, if you want me to send it to you.
That'd be great.
It's a nice thing to share. Tom, I know I've sent it to you in the past, but.
Any other questions?
Okay.
Well, again, thank you all for coming. I don't want to, take up your time. Appreciate all the input and the togetherness, and enjoy yourselves, and don't shovel too much snow, and stay healthy.
Thank you for
Thanks for
inviting
having
Great.
me.
Thank you.
It was
Tom,
excellent.
it's great
Diane.
seeing
Great
you.
job, Diane.
Yeah.
Oh, thanks,
Great
guys.
job.
Thanks for the
Thank
presentation.
you.
Take care,
Oh,
guys.
you're welcome. Thanks so much.
Be well all.